Moody's Investor Service has today assigned a local and foreign currency issuer rating of B1. That's to the government of Kenya, and the country's Monetary Policy Committee decided to reduce the central bank rate by 200 basis points. That's to 11%. Joining me now for a look at the Kenyan economy, Roy Daniels, Head of Africa Trading at RMB. Thank you so much for joining us, Roy. Okay, so let's start off with, I suppose, Obama, because Obama obviously has his heritage in Kenya, and the question mark for everyone is, what has Obama firstly done for Africa, and could he have unfinished business that he will come back to, I suppose, have more progress and more positive momentum in Africa? So what are your thoughts on the Obama re-election for Africa right now?
I think it's great for us in Africa. I think there is a strong tie to it. I mean, whether it just be a psychological tie, whether it be actual flow of funds into the country, but I think it's a good tie. I mean, we trace the roots back to Kenya. We were waiting today, joking, to see if they're going to declare another public holiday following his re-election. We haven't heard any news on that yet, but I think it's good news for us. It ties us well into the American funds. And generally, yeah, good news. I think if we look at it from what has changed now that he's re-elected, personally, I think it's from a business as usual now for America, get back on getting the economy back on track. And Europe has enjoyed a bit of a lull in attention. I think it reverts now back to the European markets, see what's going on. Nothing has changed there. So I would cautiously say probably a risk-on environment. Potentially then keeping an eye on what's happening in Europe to see what the outcomes are there as well.
Yeah, we are. I mean, we certainly are seeing that reflected broadly in markets today. Focusing in on Kenya, of course, MPC today, 200 basis point cut in the key lending rate. They're in line with expectations. The question, though, is you've got kind of credit lending still quite high. You've got mortgage lending still quite high in the economy. What side effect would this kind of reduced rate have on those already high rates?
I think we're going to enter a situation the same as we had in Zambia, where the central bank's going to cut rates to try and force these lenders to bring rates lower. I think when you look at lending rates of 20% against inflation of 4.5, 4.41%, I think we look at that and say it's time that these banks started lending cheaper money to the smaller businesses. I think it's a big step politically to say, that the government there is committed to trying to re-establish the growth rate. Growth coming in just slightly lower than expectations at the moment, but I think we're going to see a push on the rates there. As for the 200 basis points, it surprised us a little bit onto the top side. I know there was calls for 300 basis points from some places. We were slightly more cautious in it, thinking that food inflation was creeping back in. Has the rate cycle reached the bottom? Clearly the central bank sending out a clear message that they want the growth to be re-established. They're going to focus on economic growth, try and boost up their equity markets as well. More rate cuts in the new year. We'll have to wait and see. We'd struggle to find reasons for further rate cuts.
What is your assessment of why mortgage rates and public lending rates have been so sticky on the upside and not coming down as quickly as, I suppose, government officials want them to? Because speaking to James Mwangi, CEO of Equity Bank, saying that it's market forces that you need to wait for, and these dynamics take time to play out. Do you think that's an excuse, or what are your thoughts on that?
I think it's a difficult balancing game for the central bank as to how do they get rates lower, and plus by mopping up liquidity in the market, that's going to keep the short-term rate slightly higher as well. So they're playing a bit of a balancing act. I mean, they're cutting the rates, they want it lower, but they also don't want to have a huge amount of excess liquidity flowing in the markets. So we've seen them mopping up liquidity via the repos. I think they're probably going to possibly slow that down to try and get some liquidity back in the market without damaging it, but mindful then it doesn't allow liquidity to allow guys to then short the currency, which puts pressure again back on the currency. So it's a bit of a difficult balancing game. As to why the banks don't bring it lower, it comes down to credit. It comes down to credit rating of companies. It comes down to defaults. Having come through a very tough cycle and having gone through some of those problems, there's going to be a reluctance then to drop the rates too quickly.
Yeah.
But I think ultimately those rates are going to start coming down quite sharply, especially on the mortgage rate side.
And I mean, how quickly does this then feed through into the economy? What's your assessment? It's hard to tell, I know, but what are your thoughts on how much of an impact this will have on stimulating borrowing from the private sector, and specifically those small and medium-sized businesses?
I think if you're sitting in those small and medium-sized businesses, you'd probably say not quick enough. But I think that leading through this sort of December period, get through a bit of consumer demand stage, I think we'll then see some easing of rates coming through for the guys. They've come down from 25% to 20%. I know we can say it's coming off an exceptionally high base at 25%. There's room for it to come lower, but mindful we don't get into the stage where there's excessive borrowing, then that your money supply then goes to the roof, and that leads to inflationary fears, and that starts to push those rates back up again. They want to get some stability there, having come through a particularly tough time, I think, when you look at it through the beginning of this year and last year.
Yeah, you also look at, the huge criticism that the central bank had to withstand last year. So delicate balancing act for them. Moody's also coming out with their rating today, first-time rating for Kenya. In fact, of course, that is always an interesting sign when they come out with the first-time rating, B1, below investment grade. Overall, what are your thoughts on the kind of the key drivers for that rating?
I think it's key for them to look at markets in Africa, where if we look at the map of Africa, there's so many countries that don't have ratings and haven't applied for ratings. I think this move encourages countries to say, being involved with the rating agencies, getting ratings isn't that bad. It's a good thing for us. If it leads to some foreign investment into our bond markets, into our equity markets, then these are good things. So I think they're using the big economies as an example for the smaller ones to say it's not all bad news. To get a rating BA1, not too bad. I think it's a long way to go to get to investment grade, we know, but it's the first step in the right direction. I think it's a big encouragement, I think, for the rest of sub-Saharan Africa.
When you look at the fact that it is below investment grade and the fact that they say that in order to get a large amount of FDI flowing into the economy, you would need it to be investment grade. Is that really the case in Africa right now? Do people really have that view? Because, that being said, yes, FDI needs to go to a place where people assess the risk on a global scale. People know that there's growth there and people know that there's opportunity for making money, basically.
I think it comes down to what is actually within the mandate of the investor. The investor's mandate might say that they can invest in emerging markets, but you can only go into countries that have investment grading, so you allow so much of your portfolio exposed to emerging markets with investment grade, and then so much of a far lesser amount to the non-graded or the non-investment graded countries. So it's extremely important for those guys. The guys in country have no say about how much money is coming in. It depends on the portfolio managers exactly where they're going to take their funds, and they are going to look at who has an investment grading.
But from RMB's perspective, as a company in South Africa, a lot closer to these African economies, evaluating the risk is a lot easier for you. Do you feel that you have more appetite for investing in countries like Kenya below investment grade?
I think when it's got an investment grade, it reduces our capital cost requirements, and that's a key thing for us, especially going forward into next year. So it's key for us as to where the actual ratings are as to what the capital costs us to invest there. So yes, we're closer to them, but it doesn't change our view in any way from anyone overseas.
The costing perspective, basically.
The cost of perspective of investment. And look, it's great for us. I mean, we're probably slightly neutral on Kenya right now. I mean, we're a little bit concerned heading up to the election period. But yeah, I think the ratings are a key driver for which gets our focus.